Okay, cool. Hopefully everyone can see my screen and we can kick it off here as well too. So feel free again to submit questions and Tim can go hop in and share them as well here too. So the kind of purpose of today's session is to talk through how every dollar in a portfolio should have a job and a function. And oftentimes we see people who build this elaborate portfolio because they like certain things, they decide about certain things, but really, when in reality, when you go in and break down your portfolio, each dollar there should have a certain function and certain service that it's providing. So, for example, right, people own all these different positions, maybe you're in syndications, maybe in public markets, maybe you have retirement accounts, right? But not all of your money is tied together in a way that really builds a cohesive portfolio that really serves you for where you are in your life. And, for me, probably like a lot of you here too, like I didn't start in finance at all. I was in tech prior to this. So I started out, cold calling. Actually, Tim and I did that together years ago at a super small startup here. And, not in finance at all, didn't study finance, in college, right? Really just focused on the sales side and got a big interest for personal finance the last, 10 years or so. And, for me, like I owned a sales number. I worked in, leadership in a company, right? And really owned a division of sales for a larger company. So not finance at all, but learned a lot of things that then carry over to this business as well here too. And, along the way, right, I've invested down probably 15 different asset classes, over 100 deals, including a bunch of active deals myself too as a lead sponsored operator over the last just 7 years alone. And then also a bunch of deals, kind of independently owned prior to this as well too. So I've had my learnings along the way, right? The good, the bad, the ugly of this side of the house too. And when you look at a portfolio, right, I think there are different jobs that each dollar you have in your portfolio should solve. So the most simple one here is income, right? You want to have, part of your portfolio that provides you with consistent income that you can go live off of, right? It's very, very tough to go eat equity. So this is income is you can actually go live off it. It's recurring in some way, right? It comes to you consistently. The next bucket of capital here you can look at is growth. This can be dollars that you are, placing to go build your principal balance longer term. And we'll kind of cover what a lot of these different areas are. The tax piece, right? If you are a high earner and you are an investor, right? One of the biggest expenses, if not the biggest expense you will have, is your tax bill. So allocating in certain ways to go help on the tax side. Again, none of this is legal, financial, or tax advice. There's more of the things you can go think about yourself as you start building your portfolio. Fourth, and this is a big one too, is liquidity, right? How do you think about how much cash you keep on hand? And I'll cover this myself here shortly as well, is that the cash I keep on hand now in liquid or kind of liquid adjacent type opportunities has gone up dramatically as I've given up my consistent paycheck in the corporate world, right? If you are someone who is earning hundreds of thousands of dollars a year, if not more, and you are living on far less than that, the amount of cash you may keep on hand may look totally different than someone who is in the building phase of building their own business and kind of living off of that cash flow today too. So depending on where you are in your life, this number can look very different. And then I'd say lastly is asymmetric bets. So things that can have massive upside, make them a smaller piece of your portfolio. And I'd say there's one here that's not listed as well too, right? As you get deeper into your journey, deeper into your net worth, right? You may look at allocating money based on beliefs you have or values you have and really focus on the legacy building component of it too. Right? I know there are a lot of family offices we speak to that are really focused on leaving a certain legacy. They've entered certain asset classes for a specific, more emotional type reason, but they are going to cover these main five. So income, cash, growth, growing your principal balance, tax, so you keep more of what it is you earn, liquidity, money you can actually spend today, and then bets that make up maybe a smaller part of your portfolio but have really big upside overall too if they hit. So the income component, right? There's obviously way different, tons of different ways you can go look to go earn income and consistent yield. So how I think about this is that this is consistent, this is durable, this is, in your mind, repeatable, right? You can go bank on this type of income. So things that can go into this bucket, you can have equities that pay dividends, right? Private credit and private lending. I'd say for me, a big portion of my investments are into this bucket itself too, and I'll explain why. Um, Preferred equity, right, in terms of being positioned in the capital stack so you get paid more quickly and ahead of common equity. Cash flowing real estate. And then also kind of looking at this ties into liquidity and kind of short duration stuff here as well too, is that you can have money into treasuries or short duration paper as well too. And growth, right? This can be anything from private equity, right? Investing into companies you own yourself, investing into companies as more of an LP, right? Growth equities in terms of different stocks. This can be things that are value add that have a heavier lift. Usually what you're seeing on the growth side is that if you are going for growth, you usually have an indirect relationship to cash flow, right? The higher the growth is, typically the cash flow will be lower in those areas as they're reinvesting back into the company or the business or whatever it may be. Like take, for example, in private equity, if you want to go grow a blue collar business, which we had done ourselves internally, right? It takes a lot of cash to grow. In turn, that may hit your cash flow overall. So there are always trade-offs in looking at building your portfolios that, yes, there may be some cash flow in growth areas, but the likelihood is that if you're going for bigger growth, the cash flow is likely less than a period of time too. So understanding what is you're getting into and kind of the intention behind those dollars are really, really, really important as well too. Equity and operating businesses, pre-IPO secondaries, anyone who invests into the SpaceX pre-IPO is probably pretty happy right now too, and looking at how the secondaries have paid off them as well. And then search funds. Search funds have become really big recently, right? So these are kind of backing someone who is going out to buy a business, right? And with them as the operators. So you're seeing a huge, huge, huge boom in things like this. These can be great opportunities as well too. And the tax side, right? There are a ton of different things you can go do to be more efficient in the tax world, depending on what your background is, how it is that you make your money, right? One of the biggest ways that I've seen the tax side is through the depreciation, especially if you can qualify as a real estate professional, right? Meaning that, again, not tax advice, but if you can qualify for professional status, you can then typically use that depreciation to offset other income, right? Meaning that real estate is your primary function. This depreciation component of it is massive. And then obviously the king of depreciation in real estate ties to mobile home parks, RV campgrounds, which have massive depreciation when looking at that as well. Things like equipment leasing, right? We see it a lot in our space too when looking at, we have a lot of heavy equipment in the paving world. So that is great when looking at the ability to go buy heavy equipment, right? Take those losses as well too to make the business itself more tax efficient. Cost segregation, right? So for all things real estate, the ability to go break down that asset into different pieces that can depreciate on a more accelerated cycle overall. Oil and gas, I have personally not invested in oil and gas myself, but I know there are a lot of benefits to it as well, especially if you have working interests. Typically, to my knowledge, those working interests allow you to go claim those losses against ordinary income, right? So it creates a huge opportunity there as well. Opportunity zones, I've even seen someone do this with a jet company, right? In terms of planes, if you're going to make them qualify for opportunity zones. I haven't verified it, but really cool concept there as well. More commonly, you'll see this in certain areas being developed, where if you invest into the area, hold it for 10 years, right? Those capital gains are entirely tax-free. So again, great opportunities there as well. And if you're in the public markets, tax loss harvesting is really interesting too. So for example, if you have 10 positions in stocks and you have 2 stocks that are getting their butt kicked, right? Selling those stocks off, banking that loss in the year 2 to go potentially offset other gains that you may have. And liquidity. This is a really big one, especially if you are in a position that you are living off of your cash flow. So, say you're going out and you're building a business versus the W-2 employee. Like these people think typically really differently from where they're at. Right? Again, take, even myself a handful of years back as a mid 6-figure earner in tech, knowing that every 2 weeks I had a paycheck coming in, every month I had a commission coming in, every quarter I had stock or a bonus coming in, right? I can go think about liquidity much different than if I'm a business owner who is investing heavily into these companies that we're building and growing and not taking a lot of cash out of them. So your stance on liquidity may shift dramatically based on the position that you are in. So I think liquidity in a few ways. So number one, obviously, is how much cash do you have on hand? And I think that's a ratio. So for example, if you spend $10,000 a month and you've got $50,000 in hand, right? You've got 5 months of runway on hand here as well too, right? Assuming you have no other income coming in. Alternatively, you may have money in short duration type investments. Maybe you have money in T-bills, maybe you have money in private credit that you have access to in a 3, 12, 6 month period of time. So I think of that as liquidity adjacent. So if I have, 6 months of cash runway for what I spend relative to what I have in cash, and I have money I can go tap in 6 months if I need it, I would likely feel far more comfortable because I can go get access to that cash later on if I run through my runway as well too. So this can be a whole variety of things here as well. But again, I kind of think of this as cash you have access to both the short and the medium term. And I'd say this asymmetric bet component of it is typically a really small part of someone's portfolio, but it's a part of the portfolio that if, I think I have like 2% of my money in Bitcoin, right? Which is getting its butt kicked right now. But in the future, if it goes up, great. And how I think about it is that that's a very small piece of the total portfolio, where if that goes to zero, I'm okay with that. Like my life and my livelihood aren't threatened from that. But if it really hits in a big way, that 2% can have a meaningful swing across the board too. So these can be things like venture capital, these can be things like angel and pre-seed investments, right? These are respective positions that aren't going to kill you if it goes to zero, but they have a potential to return big amounts if it goes really well. And again, like this is a good example for someone who's focused, like just, an example of someone, right? They're focused on, you have an income component, you have a growth component. They're keeping a lot in liquidity right here as well. This is likely, maybe a business owner, right? That is focusing on between half their money is in, income and liquid positions too. So for them, like clearly they are focusing really heavily on having access to their cash. So really important things here as well. And again, like it depends on what stage of life that you're in. Like if you're early and you're building, right, you may want to have heavier income, heavier liquidity, right? If you are living off the yield. So again, take that person who just made a jump. They left the corporate world, they gave up their big salary, and now for them, they're looking at, okay, how can I go live off of this yield for the time being, right? Your portfolio may look more, very cash flow heavy, a lot in liquid cash, right? There are certain things that are, intangibles around how you feel around the psychology itself of money. So those are really important things. Because I don't know, I think it's tough to go build in certain ways if you're totally stressed out financially. Like I know personally, I operate really well under certain types of pressure. Like personal financial stress, I'm okay making a lower return to give myself more runway and kind of peace of mind while I'm doing it. Just because some businesses, if you're building, like you usually don't suck cash of a growing company if you want it to go actually grow. So really important things to go understand too as to what phase of life that you're in, that you can go build appropriately and give yourself enough runway to go do so. Maybe you're in the accumulation phase. Like if you're, a high earner, you're just stacking away cash in the future, you plan to go live off your current cash flow, right? If you're not doing it today, say you're making $500,000 today, you live off 250 and you've got 250 left, right, to go allocate to things. If you already have that delta, for you, cash flow may be less important because you already have extra money every month, every quarter, every year to allocate. So you may be in a position in which you are stacking away all the cash you possibly can, right? All the principal amounts you possibly can. You're focused solely on growth because that in the future, you're going to move to more of a preservation type mode. Where if your principal balance gets big enough, you're saying, okay, I can go comfortably make 7% net of taxes on money every year. So, and I need to go have, $140,000 a year to go live so that you're in a sprint to getting to $2 million of accumulation. Then once you're there and you want to go live off of it, you may flip to more of a preservation type mode. You're taking your cash in the business. You're taking your cash flow, right? Your goal is to go protect your base and go live off the yield that you have. So again, depending on the stage of life that you're in, you think of money differently in each step. And, I love this too. Like they're totally different in function, depending on, again, who you are, where you are, all those things, right? Your focuses look very, very different, right? So again, let's start actually the bottom left here. Like if you're the long runway accumulator, your focus is solely on growth. Maybe you have some in there too where you're saying, you know what, I'm okay making some bets that if they pay off, they pay off. If not, I can go live with that, right? Maybe you're someone who is just that high income earner where your sole focus is how do I go structure my life so that I can go pay less in taxes, right? The high W-2 income earner, their biggest bill, hands down, you have the least flexibility, is on the tax side of the house. And again, like if you're building, you're early, right? Income is focused here because the business itself is actually your growth engine. So again, if you kind of take a step back and look at the person who's really just building, they may not really care about growth from an investment perspective because their full effort and time is going into effectively a growth engine because they are taking all of their effort and sweat equity to go build a level of equity and future, enterprise value in their company. So for them, they have to go solve for income somewhere else. And lastly, like the preserver, this is someone you kind of think about, typically someone who may be older or transitioning to the more passive way of life. My mom fits in this category personally, right? We have a lot of her capital into things that pay her really consistently, right? Because she's getting ready to hopefully retire soon. And for her, that income piece of it to allow herself that runway of saying, okay, I need X, I have to have this multiple of X, and I'm good to go, take a step back. And this is mine personally, right? In terms of the breakout, and I'll explain why. So private credit is at the biggest allocation for me right now. That may change in the future. And the reason I have this as the biggest allocation today is that, we are building a few different companies right now, and those companies are really focused on long-term growth. And we are all in on building the right way. And sometimes building the right way means that, it's for future you versus today you. And in turn, right, you may take very little cash out of the companies while you're building, as growth is expensive. So on our end, right, what I've engineered for myself is that I want to be able to go live off of the cash flow from things like private credit. Also, it falls more into that, liquidity adjacent type bucket. A lot of my money is in things that have a, 3 or 12-month lockup, and I can go call it back in a window of time. So I know that, hey, if I have, this much in cash, this much runway, and I need access to this cash to a period of time, I can go call it back in that window if I ever needed to, right? To get ahead of that liquidity. So I only keep 5% in cash, but I have access to more of, 30, 40% in cash as well too, over the next, 6, 12 months as well. Real estate, for me, it was a big piece of the last few years. We have a lot of positions that we'll likely swap out of as the market cycle itself starts to shift. It's also helped me a big piece for the tax purposes as well too, in terms of depreciation and things like that. Private equity, we invest really heavily into companies, specifically paving right now. So I'd say that kind of falls more into a growth play for us, both on the SMB and the private equity side, as these are companies we plan to go hold long term. I'm going to look at the overlap of it. They are not income focused today; they are much more so growth focused as well. And then obviously cash is kind of self-explanatory, is that we think about cash in a way of this is just our runway, this is our operating cash for our life and our business. And then Bitcoin is kind of my asymmetric bet. I don't have patience for venture to go look at deals, evaluate them, put a few bucks there. If it hits, it hits. If not, I'm totally okay with what it goes to. And if you kind of look at the, breakouts, right? Again, a lot of the compensation is delayed in building a business for the long term. So for me, right, a big piece that is in the income bucket, growth makes up a lot of this, right? I'd say, the tax piece also gets carried into both the growth component, right? But real estate, private equity, SMBs, these are long-term growth type plays for us. And then liquidity, asymmetric bets on our end here as well. And, I think the sizing matters quite a bit on our end, because we're also diversified across the board in each one of these areas too. So for example, like our income bucket is made up of private credit, private lending, right? Different buckets, different opportunities in that one bucket. We're not entirely with one sponsor, one allocation, because no matter how good it is, you don't want to be over levered in a given area as well too. So liquidity, right? The reason there is that it allows us to go be, holders long term in other things that we own. I'm kind of looking at never being a forced seller. Income, right? Kind of covering the buckets of life that you have, right? Tax allowing us to try and keep as much as possible of what we make, and then likely will earn in the future too. And then growth, right? Focusing on long-term growth with money we won't need in the short term as well here too. So your question, yes, the deck will be available as well after. Happy to go share that out to you. And then again, like asymmetric, these are kind of smaller bets that we make that we think have a big shot. And again, kind of diving into like what this actually does, right? So yes, the income bucket is one bucket, and we're very heavy in private credit. but that can be broken out in different ways. So, these are different time horizons, different risk profiles, different types of yield, different types of income as well too. So having your buckets can have subcategories here as well too. So again, depending on where you are and what you want to go do and kind of how you're thinking about it and what risk tolerance you have and where you're comfortable, I think the biggest thing too in investing is like making sure you're comfortable understand what it is you're actually investing into. That way you can go understand the risks, understand the positives of it, understand the timelines, horizons, et cetera, around all of this. Like a big thing too in looking at things in private credit, I think there's a lot of bad precedent recently, is that making sure you understand what your actual liquidity window is in that offering. Some offerings have, say, a 5% per quarter liquidity window, which means that if you're not in that window, you can't pull your cash out. It's also really important to understand what the underlying assets are if you're banking on liquidity. Like what they have to go sell off, how does that happen? Is it actually saleable in that window of time to provide your liquidity as well too? So obviously first it's the docs you sign in any investment, right? Understanding what goes into that. But two, the underlying assets actually support what the documents say and what the intention behind it is. So all really good things to think about as you're allocating potentially this asset class as well too. And, if you're investing into the private markets, right, there is usually compensation for folks involved too. So understanding, right, if you're the investor, what each offering does well, right? Is it income focused? Is it a growth vehicle? Is it focused on tax? And making sure as an investor, you know what it is you are investing into and what it is you're buying, and having a clear intention of what that dollar is going to go serve for you. And, how it pays you, right? Every bucket of investments have different economics to them. Maybe it pays you, monthly, maybe it pays you quarterly, maybe it pays you in 5 years, right? And understanding, what goes into it from the manager standpoint too, and how there's alignment in those structures as well. And here's just an example, right? We've, on the other side of the house too, from the manager standpoint, right? Knowing what it is that your side of the house is as well too. I know people on here, maybe you are a high earner, maybe you are a fund manager, maybe you're a high earner looking to be a fund manager, maybe invest in private markets too. It's really important to understand both sides of the equation. So first side is if I'm the investor, understanding how am I compensated, how I'm being, returned capital, what the investments are, right? What's being paid to me, the waterfall of how it's being paid to me. And if there's a manager where he's making money from this offering, how is it that they're making money? So this is an example here, right? Where maybe a fund manager invests into a really big class of share in an offering and they get 16%, right? For bringing a really large check to the table. And then the investor themselves, right, gets 10% based on their threshold and their check size. So in turn, if that deal hits the full return of the 16, investors get 10, the fund manager gets 6, right, in terms of spread. So these numbers obviously can go change depending on the offering itself, but it's a really simple structure as well too in looking at things like private credit, private debt, lending in terms of how different folks in a deal make money for what they're doing. And understanding like if you are investing in private markets too, how are people getting paid and compensated? So if you are in a fund, are the replacement fees, are the preferred returns and profit sharing? So I'll break down what each one of these things are. So some deals, there are fees based on placed capital, right? Understanding, are they making money for just placing your money into an offering? That can be fine, but just make sure you understand how much it is, what you're getting for it, all of those things. A preferred return focused on, right, how much you are paid as the investor before the manager takes their their share of fees and their share of split. Usually the profit sharing split will kick in after that preferred return. So say, for example, you put in $1 and the preferred return is 8%. Means the first 8 cents goes to you in that scenario. Over 8 cents, it's split 60 cents to you, 40 cents to managers. So understanding kind of what that structure itself looks like, right? Just making sure you're familiar with it, comfortable with it, on board. For a real estate syndication, usually same thing. Maybe you see some form of an asset management fee in terms of an annual recurring fee based on revenue, based on equity, all those things. Similar to operating companies, again, maybe you have ownership in an entity, maybe your preferred equity, maybe there's management fees, maybe there's upside, right? Understanding how each of these pieces in the equation come together and give you a holistic view of how your returns are, your waterfalls are, and how the manager themselves gets paid too, right? In equity deals, what's really common is that the managers don't get paid the bulk of their compensation until the exit. So making sure you as the investor have very aligned interests as to how the managers themselves get paid. Do they get paid more for just doing a deal, or do they get paid more for performing on that project for you? So those are all really important things to go think about here too. We've got more questions here. We'll hop in. If you invest 100K into an equity fund or syndication with a 3% ACK fee and 8% pref, does the investor get 8% on 97K or 100K? Okay, really, really good question. So the most common scenario is that the investor themselves will get the 8. So what you're asking is, if you have master fund, right? Or sorry, if you have the master fund and there's a 3-point ACK fee on the deal, do you get the 8% preferred return on the 97K invested or the 100K? So the return should always be on the total amount of your capital. So if you are putting in 100K to a deal, your preferred return is on your entire capital stack that you put in there, right? That 3% of acquisition fee dilutes the deal slightly, but your returns are still based on your 100K itself. So you should be getting your preferred return on the total amount that you invest, not the total amount that is actually net used capital to go buy assets or whatever it may be. So again, really important point here too of looking at how the capital is allocated, making sure you're paid on the money you're actually investing. Cool. So alignment is really important here too, in terms of who gets paid first, is there actual co-invest, what kind of carry is there above a hurdle, right? All those things to go look for, right? Especially too, this is a good one. Are there clawback provisions in the deal itself? And what I mean by that is that, say you invest into a deal that is, again, 8% preferred return, 60-40 split thereafter. If that deal, right, say it's crushing it during the whole period, the 8% is trued up, and the waterfall goes preferred return, profit split. At the exit or capital event, there's return of capital. So this is a good one. So if the deal is performing at, say, 15% cash on cash, what would happen is that investors get the first 8. The next 9 is now split 60% to the investors, 40% to the operators. So meaning that 9% goes, part to the 5.4 and 3.6 effectively. So the manager earning 3.6% per year. Every year they're hitting that 15 in that example. But say that deal actually loses money, right? And the deal sells in the future, but it sells at a loss. Are there clawback provisions to go true up the investors for the profits the managers have taken, without actually being profits there because they're not a return of capital? So, small detail to go look at, but really important as well too. And understanding things to go look for, right? Are there fees in deals regardless of whatever the outcome actually is? And certain fees are fine, right? Groups have to go keep their lights on, but are the fees excessive? Is the fee business their entire business, or are they really focused on the remote of it, right? So, skin in the game, all those things too, like just making sure it's aligned. There's a lot of ways to go say this and review it, but just making sure you feel comfortable as an investor and can understand how and when the owner and manager are being paid. So this is a good one too, right? Understanding that a manager you invest into that's stable is likely much safer than a manager you invest into who has delayed too much compensation. And it may feel contradictory to what I just said, right? Most of the managers in the private markets, their compensation is very, very back-ended. If I'm looking at this from a deal perspective, I feel more comfortable investing with someone who has some form of current income, right? If they're struggling to go make ends meet in certain ways, the likelihood that they have, issues that arise that impact their stability to go manage the deal appropriately, I wouldn't feel as confident in. So making sure that, they hold cash in hand, making sure they have some form of income itself, right? All really important things when looking at them not being too deep, waiting for a 5-year hold that may or may not materialize. And again, here, right, give every dollar in your portfolio a job. An action you can go take from this today is dive into your portfolio, right? And go list out what each of the jobs your investments are doing for you today, right? Kind of think about where you are in your life and what goals you have and aligning it to where you are and where you want to go, right? You should be able to go clearly tie each part of your investment portfolio to something that, like this, right? Income, growth, tax sheltering, liquidity, upside, right? make sure there's a clear intention behind it versus just throwing deals together. So again, thanks for diving into this and watching. We'll open it up here for questions. I know I had a few submitted ahead of time too.
Yeah, Sam, I'll drop some in the chat. We had some really good ones submitted ahead of time.
Cool. Yeah, feel free to hop on here. Anyone to go through our questions in the chat, and we can go into them. So anything around portfolio creation, manager compensation, kind of all those areas too.
Here, I'm actually just going to ask him. I'll fire him off. What is one thing you think would be most helpful to an emerging manager to know and execute that is not obvious or common knowledge? That was one of our guests.
Yeah. So yeah, this is a good one. So I think understanding, right, your long-term vision versus just going in and doing deals. So kind of figuring out and getting clarity as to what type of projects you want to go do long-term and kind of how you want to build your business is really important. I think obviously like the whole portfolio construction of what you build too. So for example, if you want to go all in on this business and you want to go be a fund manager full-time and you're only focusing on equity deals and you're making very little amount of money up front, you have to go figure out how do you go bridge that gap in your earnings in the short term. So, right, how do you go have recurring income to be able to go higher the right way, to be able to go sustain long term? Because what people don't realize is that this business is a very, very back end weighted business if deals perform well. So it's really important to align yourself to be able to give yourself enough runway to go have a chance to go succeed. So you need to either have very, very ample cash on hand, give yourself meaningful runway. A lot of these deals are 3, 5, 7, 10-year deals in private markets. So understanding, how you get through that period of time without having to have massive earnings is really crucial to go think about. Cool. How much fund manager or sponsor compensation is recommended? So I'd say it really depends. If I'm looking at this from the standpoint of an investor, where I'd want to see this is that, do I get preferential terms going to a co-sponsor, a fund manager, rather than going directly to the sponsor themselves? So what type of insulation or protections or buffer room or waterfalls or term profiles do I get by going to that sponsor? So going to that fund manager. So what I'd say is that as an investor, I'd look at it from the lens of how can I get better economics or access going to them. From the standpoint of the fund manager, how I think about this is that, do I have enough buffer room for myself to go be profitable enough for the work I'll have to go do and risk I'm taking on doing this deal, right, relative to it? So things pay different ways. So for example, an income fund may pay you a few percent per year in terms of spread if it's hitting their goals. Whereas a multifamily deal may pay you, and again, these are just rough guesses on it, high single digits over a 5-year period, maybe 8, 9, 10, 12% at pro forma relative to the size of your fund you're investing into that deal with. Private equity can be a lot larger. So how you think about it is that what's the spread in the economic share classes of those deals? And the higher the return profile, use larger spread of those shares are. So all those are things to consider in terms of how you get paid, when you get paid, the likelihood of it, and how much there actually is spread-wise too for yourself. So, okay, this is a good one. Net worth is great, but you cannot eat net worth. The cash flow is king. That's a great one. It's really important too. I've seen folks, especially in the real estate space too, who have awesome balance sheets, but for them, they, are very illiquid, right? So there's a balance of long-term growth and balance sheet, but it's definitely a balance to making sure you can go survive too, right? If I were to win $100 million lotto next week, what would you advise I do for the remainder of the year to reduce my taxes? So I'd say it depends on how the money itself is coming in. My best guess would, if you have that much money coming into yourself, spend a lot of money on tax turning type opinions and tax planning ahead of time. And take some time to go figure out what you actually personally want, right? That's, life-changing walk away type money, where if you have that much, the amount of money you'd spend on high level consulting for a tax professional is really, really inexpensive relative to the total outcome you can go have. Because you're looking at, in capital gains, $25 million in taxes or your income, $37+ million in taxes. So spending 15, 20K with a tax professional is likely the best investment you can go make before you go, write checks to go different deals and such too. Okay, what are the advantages and disadvantages of an SPV versus multi-asset fund from a fund manager point of view? So on the SPV side, it's easier to go manage right from like a back office perspective. Um, could you clarify what you mean here too? If you want to come on, I can give you the mic here. One sec. So Aaron, I put you on the mic here. If you want to hop on for a sec.
Yeah, can you hear me okay?
Yeah, we got you.
So if you have, let's say, 5, 10, or 20 assets in a fund, so it's like more of a blind pool. They're putting money into a fund, right? Versus just a special purpose vehicle, single asset that has a shorter time frame to it. You got to fund it, and then you have to work the project, the business plan. I'm just curious how, like you mentioned, easier to manage versus the blind pool, where people could be putting money into something that there might be capital not even allocated yet, right?
Yeah, so I think on the blind pool side, it's really tough to go out and start raising capital in a blind pool fund, right? People, from my experience, have liked the ability to go see and feel and understand the underlying assets they're investing into, right? I think over time, if you build a really big track record and you can go build a big audience that trusts you massively to make discretionary decisions for them, compliance, like obviously talk to legal on it, but if they're doing that, that's a lot harder of trust to go build. And potentially it's a lot more work for not much more of a return for you as the fund manager for doing it. So I think the SPV is nice from the lens that people can go see and actually vet the deal itself versus just entirely trusting you as the manager. So if you're an early on manager, like it's really tough to go do a blind pool fund. There's different stages of it too, right? So like the most simple one is, hey, we have this offering, this asset class, this deal to go vet, review, analyze, see if it fits, what you want, these managers, et cetera. Second is we're buying deals that look like this. So say we're buying, this type of company, this area, this demographic, this size, right? Go allocate capital to us. Third, it's, hey, I'm Aaron, trust me, I'm putting money into these areas, but I got it, right? So when you look at the trust piece of it, it gets harder and harder each piece of the puzzle because they're more and more betting on your discretion in those areas too.
Great. Thanks.
Mm-hmm. Tim, what else do we have here too?
Yep. So we got, I'm a high income earner. I want to have a fully sustainable business to walk away from my W-2 in 5 years. How would you do this?
Yeah. So I think this kind of ties to the same way I build a portfolio if I'm a high earner myself, right? Is you focus on the income piece of it, right? Where you have to go back into a number. So for example, if you're saying, okay, I need to go make $200,000 a year, and that can come from a few different areas, right? So obviously the first area can come from is your own money being invested for cash flow. And it's your confidence in that cash flow that what that'll produce. Second, if you're going kind of the fund manager type route and you're building a business around this, is you want to see what's your likelihood of current income. And what, from my experience, where I've seen the most consistent current income is in the private credit, private lending, right, debt space, where it's more predictable in terms of returns. Maybe you give us some upside, but you as the manager can go build in, right, really predictable spread each month or each quarter. So for example, if you're getting 16% top line and you feel confident in whatever that deal is, it's saying 16%, and you're paying your investors 12%, right? You have a 4% spread every year in that model. So you can go back into it saying, okay, I need $5 million, right, in that offering, consistently performing and hitting it to go get to $200,000. So what I say is it's a combination of, one-time earnings, of recurring earnings, and things like income funds or credit funds. And then it's whatever you've invested to go get to that number over that period of time.
That's really helpful. Sim, we had another question. You showed it on the private credit side. Can you explain fund manager economics from like a super high level across some of the other asset types?
So as a fund manager, what you may see is that you may take a upfront due diligence fee of some kind, meaning that, hey, if you place $1 million, maybe you take 2% of that $1 million in terms of a due diligence fee. So that's kind of more of an upfront fee for putting everything together, writing a check, etc. Alternatively, you may then see the bulk of your compensation, because usually how your compensation will work is that you don't get paid until certain preferred waterfalls are hit. So say that it's 8% in terms of a waterfall, and then you get a piece of the promote therefore after. And if the deal itself is only hitting 7%, there's no excess cash flow for you to go receive that. So in turn, the bulk of your compensation will be in the back end of that deal. So if that deal's a 5-year hold, right, you may not make money. You may make a little bit up front, then hopefully a lot more cash in 5 years with aligned interest investors. Once you pay them their hurdle, then your profit sharing split kicks in. So I'd say usually it's maybe upfront fee, maybe some form of ongoing management fees that are usually very nominal. And then usually the biggest piece of earnings is tied to the back end. More so things like private credit, income funds, debt funds, right? You can go have more of a higher current yield that is paid more consistently, but you may be giving up that back end pop as well too. So each different type of deal is different in how it pays you, the likelihood, the consistency, and kind of when it happens as well.
Awesome. Thanks. There was a question around biggest lessons in the beginning, starting out, the what not to do's.
Yeah. So I think really understanding the economics of a deal and the underlying assumptions in a project are really crucial, because what people don't realize too is that these deals are 3, 5, 10-year holds going into it. So really understanding the biggest thing in private markets is that these deals are illiquid typically, and understanding that illiquid means there's no way of getting your capital back until the deal has an outcome of some kind. So making sure that you're comfortable with that, and your investors are very well aware of that as well too, from both the manager side of the house, the investor side of the house too, is that illiquidity is a really big thing, and making sure that if you're investing, you're being compensated appropriately for the illiquidity you're taking on. Cool. Any other questions from the audience? I know we still have some folks on here as well.
The one thing too, we actually did have some additional questions and somewhat different topics, which I think is a good segue into, this series. One was more specifically around how to build a flow of interested qualified investors. And then we had some other questions around, the best use of AI to, better engage prospects and potential investors. So it may be helpful if we have, people on right now to share additional feedback or topics that we want to keep digging into, just so we can keep, as much value as possible for this group.
Cool. And to go touch on the first one in terms of who do you go talk to as investors, I think you really start with who's around you in the first place, right? In terms of who it is you have access to. On my end, when I first started, my background was in tech sales, and in turn, all my contacts, connections, people I was around every day were in tech sales. And that was a easier pivot for the reason that I was really investing heavily myself. I was doing this every day, been in a ton of deals myself already, and you can kind of go have those conversations more easily from a peer-to-peer conversation. It also definitely helps that the audience itself had, usually good income, right? So if you are, in a field or your connections are not overly high income, but doing an audit of who you have access to that may have more access to capital as well, which I think is really important. It's not a great use of time. Usually, spend a ton of effort on finding folks who either interested, may not have the resources to allocate and invest to as well. But cool. Well, hey, everyone, thanks for hopping on here too. I'll stay on for another few minutes if we have more questions that pop up. But feel free to send me a DM, send him a DM too, an email, right? If you have topics you want covered. We're trying to do these every month in terms of kind of deep dives into the investing world, into the kind of financial world here as well too. So everyone, thanks again for joining us today too.